Hello and welcome back to Titans of Today, episode 57. We have Yuen Yung. He is the co-founder of Albar Partners, entrepreneur, and today we are going to be talking about the entrepreneurial journey, some of the things you learn along the way, life as an investor, and really just a diverse perspective that Yen brings to the table, having been in every person's shoes along the business journey. Yen, welcome to the show.
Thank you. Thank you.
Albar Partners, let's start there. How has
Sure.
that and being an investor changed your perspective on business?
It doesn't necessarily change my perspective on business as much as what it does is gives me even more insight into how business is done. Obviously, myself being a serial entrepreneur, I have my own thought processes of how that journey should look. But now with Halbar, as we invest in entrepreneurs, it's given me even more deeper insight into the world of entrepreneurs and the psyche and the mindset of how entrepreneurs work.
What is a story that reflects that expanded insight and awareness?
That's a good question. So I think one of the ones that's most interesting to me is that what we work on at Halbar today is really entrepreneurship through acquisition. So meaning that these are searchers, folks who are looking to buy and acquire a company. And what I found was that's a little bit different than almost like a different breed. We're all dogs, but we're all different breeds almost. But I've always been a startup guy. And so I've always been in the mindset of you have an idea, you put it all together, you start creating an MVP, you start marketing and growing that and pulling capital and growing it from here. These entrepreneurs that we're working with is a little different. They are looking at acquiring a company that's already profitable, but then how to grow it. And so in the journey, they're in some ways a little bit further along than my own experience has been. Going from what I would call 0 to $1 million, they go from $1 million to 10 million, right? A little bit different psychology, different way of doing things. And so that's been the neatest kind of process and thing that I've learned now working with entrepreneurs who are looking to acquire companies.
And what is about the background? Is there similarities between the backgrounds of entrepreneurs like that who are looking to acquire and build and exit or move up to the next level of the chain? Do they come more from corporate backgrounds, or is it really, you've seen it all over the place? What's your experience with that?
It's interesting. I feel first off, it's more mid-career folks, so a little bit different. I started my entrepreneurial journey when I was 21, right? Most of the folks that are in our program are in their mid-30s to late 40s. That's the average age. And when you look at the kind of, call it characteristics of how they work, again, they're a little bit more formally educated. They're all MBAs. They've all gotten degrees. I myself am not an MBA. I've gotten a master's in entrepreneurship and finance, but not an MBA. So their technical skills are very different than the way I grew up in the entrepreneurial world. And when you think about it from a perspective of 0 to $1 million versus $1 million to 10 million, I think of the stuff that I worked on was much more about having a great idea and having to be creative and coming up with that idea and then trying to make that into real life and make it into a viable business. They come in much more already analyzing the companies that they're looking to acquire and already figuring out, okay, how do we tweak things? So one is much more of a creation process, which is to me much more venture capital feel, where you have an idea and you want to make it into reality, versus private equity, which is more of what we do today, which is much more how do we tweak and make things improve and better and the margins better. And again, very similar but different, right? So we end up sitting somewhere between nowadays. We sit somewhere between venture capital and private equity, and it's a unique hybrid position that we're working on.
So to take it back to that entrepreneurial journey where you got started, we could talk all the way back about that you were a financial advisor and helping people with asset management. Yeah, let's focus on the how do you roll and the story around that.
Sure, yeah. What do you want to know?
Talk about that process, because as you're mentioning, the 0 to 1, the 0 to
Yeah,
0,
yeah.
and you actually ended up getting investment from Shark Tank, Kevin O'Leary. And
Yeah,
so
we got the offer. We ended up not doing the deal on the back end. Yeah, we can talk about that. So let's start at the beginning of that journey. The ideation of how do you roll with my brother took us about almost a year and a half. He was a sushi chef, so he had the technical skills of how the food side worked. I'm just a finance business person trying to figure out how that marketing and model worked. And it took us a while to figure out what were we going to do and how were we going to do it and what would that look like. It just didn't exist in the world, right? And just nothing like that ever existed in the world, which essentially was create your own sushi rolls, and you would go down the line much similar to a Subway, Chipotle type style. And there's a whole process of ideation that had to go through and research and development that had to happen. So we ended up spending a year or almost over a year trying to figure out how that looked and trying to create that assembly line and how the whole thing would work. And then finally we took the plunge and said, okay, let's round up the money and let's open up a store, open up a restaurant and see what happens. And I would tell you that the first 6 months was hell. Nobody got it. People didn't understand what was going on. They'd come in, they'd be like, oh, I thought this was a sushi place. And it's, hey, what does your menu look like? And we're like, the menu looks like a whole bunch of items you can pick. And so it took a while. I think it took about a year or so before people really understood the concept and really grasped onto it. And so that was really the beginnings of that journey and how that worked. Now, over time, people started getting it. It was fresh, unique, different. People were excited, especially people who had dietary restrictions so they can pick their own ingredients into the roll. I think a lot of people love the creativity and individualism that came with the idea of how do I roll versus how do you roll and versus how do they roll. And so I think over time it caught on. And then being recruited onto a TV show called Shark Tank didn't hurt. And that put about 5-6 million eyeballs onto our concept. And so that helped blow us up.
The word of mouth, once you got established, the idea got into people's minds during that early phase, and then also just people seeing you on TV took it to the whole next level. So
yeah.
What really, how powerful was that word of mouth though, just during that first year? And how did you come to see it manifest over? At the beginning, people don't get it, and then did you actually have experiences where people were telling friends and they were bringing friends, and there was that? Did that really start to drive the business after that, or did you guys nail some marketing program?
We didn't nail it. It was during the financial crisis, so it was in '08. So terrible time to try to open a restaurant. There was no lending available. The bank shut down. It was crazy. And because of that, we had no marketing budget. That made it very challenging. Even though we had originally put money aside for marketing, we ended up blowing through it because of construction and the lack of the loans. What was interesting to me as I think back on it was really that during that time period, social media was really starting to really pick up. And you got to think this was '08, right? And Facebook was really starting to become a thing. Instagram was starting to become a thing. Twitter, all of those social media places. And this idea of people having followers or being an influencer was really starting to take hold. And it just turned out that a couple of the foodies, we called them foodies at the time. We didn't even call them influencer at the time because that was not a thing. So these foodies were going around different restaurants and having a following. And they came to our restaurant, they tried it and they filmed it. And that kind of got hundreds of thousands of people to see what we were doing, and they started showing up, and then the word of mouth really started happening. So it was kind of interesting. The concept was had a lot of theater to it because you don't typically get to see the workings of how a sushi roll is put together, but we had it right there in front of you. And so people would film it, put it on their social media. And it was a cool process overall to see how that social media really started getting our concept going. And then it was also through the internet and social media that ABC Shark Tank found us. That's how they found us, was because of them. They go, oh, that could be interesting on TV. And so that's how it evolved.
Mm-hmm. Then talk about, I'm curious, were you surprised about anything from the financial side of the business, being that you brought that finance business mind in, just how the unit economics or sourcing all the products and making sure your inventory, how different was that for you coming from finance, and what were some of the surprises that came there?
Similar but different. In the wealth management business, being my own business owner there as well, my revenue versus my cost of goods sold versus my expenses, those items existed. They were just different in the restaurant business. The way the revenue came in was different, right? And so I went so if you think about it from a revenue perspective, and sorry, I'm geeking out financially here, right? So when you think about revenue, which is the first top line thing that you look at, in the wealth management business, it's very different. It comes in a more steady, fee-oriented, assets under management orientation. and those dollars come in relative to the size of the assets you manage. When you shift that over to restaurant, now the revenue comes in on a daily basis, customer by customer, right? Hundreds of people at a time, and it's completely different, and it can shift. And over here in finance, it's like steady, and it comes in at a certain day of the month. But then when you look at a restaurant, you're like, okay, Friday, Saturday is going to do better. Monday's going to be a little slower, and everything is just so different. And then same thing with the cost of goods sold or the expenses that you had, right? Whether it was labor and the people that you had, the teams that you had. In one instance, you really, on the finance side, we really had salaried people, right? Degreed people who were paraplanners and marketing folks and that sort of thing. Over here on the restaurant side, you're dealing with hourly workers, right? A little more transient. And they weren't looking for benefits and long-term career path. They were just looking for a job. And so those are the differences that, even though on a financial perspective, all those items are still sitting there, the difference was all of those items were different in terms of how you actually dealt with them. And now all of a sudden, when finance, like stocks don't go bad, they don't spoil, right? But an avocado does. Avocado only lasts like an hour or two. And so those are the big differences and mindset shifts that had to happen. And even though numbers are numbers, it really made a difference of how you handled and operated. And so to me, those were the differences in the mental shift that had to be made from running a wealth management business to running a restaurant business.
And then how did you manage that working curve? Did you go and ask people who had run restaurants before, trying to learn from them how to manage inventory, handle the financing, and just making sure
Well, I didn't have to. I was lucky in the sense that my business partner was my brother who was in the restaurant business. So he understood operations, right? He understood avocados go bad in an hour, or you have to do certain things to the fish to get them ready. He had all that operational background. And then on top of that, both of us grew up in the restaurant business with our parents. My parents, talking about the American dream, my parents are probably the best example of immigrants coming over, working hard and building a business and then growing and raising kids from there. And so when you think about that, I was working in a restaurant at the age of 12. So it wasn't that foreign. I just didn't want to go back to it. But here I was back in the
Right, you
restaurant
did.
business.
Now, what about you talked a lot about when we had our first conversation about the preparation that went into the pitch on Shark Tank.
Oh, yeah.
Talk about the level of preparation that you put in and how founders and people that are going to be pitching anybody should be thinking about their level of preparation that goes into it.
Oh, it's tremendous, right? So there's a couple of pieces to it if you think about it, and this is how my brain breaks it down. But it starts off with, first you have to show that you're presentable, right? And how do you look and how do you talk and how do you communicate on camera? And I love these types of things where we can now start having that experience, right? But back in the day, that wasn't a thing, right? Podcasting and videoing wasn't really a thing. And so we had to film ourselves on video to see how we would actually look and the way we stood and our posture and our hand gestures and all that fun stuff. That's one area of preparation. The other area of preparation is that you have to have your initial kind of 30-second pitch down, meaning there's no retakes on that one, right? So it's like, hello, sharks. My name is Yuen Yung. This is my brother, Peter Young. And we're with How Do You Roll? We're a fast casual sushi concept. You had to have that piece like nailed down, right? And then finish it with who wants to roll with us, right? And then boom, then it's a free for all. That's the third part that you have to be prepared for in a Shark Tank scenario. That third part is actually the most critical because that's the part where they have a lot of time to ask a lot of detailed questions. And if you don't know your business, then you're going to be in trouble. That I always used to wonder how they made people cry in a 8-minute segment. And they don't. They put you in front of the sharks for an hour and the sharks are just coming at you with questions. And if you can't answer them, you're going to look stupid and then you start crying. But so that's the preparation. My brother was the one there to handle all the conversations around the food, the distribution, the operations. I was there to handle all the questions from the sharks around finance, valuation, growth of the organization and revenues and those sorts of things. And so we just had a kind of a nice combo there.
So when you went in, what level of revenue were you at? And what was the
gosh, I don't remember exactly anymore, but I'm going to guess that we were probably at 6 units open already, roughly. So probably about $5-6 million of top line revenue at that point.
Interesting.
Yeah. Yeah.
It seems to me that, at least I don't watch Shark Tank too much, but it always seems that the people that go on don't really ask for that much money usually. Like they're in, at least what
Yes.
I've seen, they're asking for
Yes.
150 or
That's
250,000.
right.
So it surprises me. How much do you guys end up going in for in terms of your
So we went in
the
for 1 million. Yeah. Which I think is still one of the biggest deals ever done on Shark Tank. It was funny because actually at that time we were really getting some good momentum. We were franchising, things were happening. And initially I was actually going to go in and ask for 3 million. And the producer said, no, you can't do that. And I was like, what do you mean you can't do that? You can ask for whatever you want. And I thought that was part of the show. They're like, no, you have to understand these sharks, they have a lot of deals. They have to sprinkle their investments. And if it's too big of a number, even if they like the concept, they're just going to be like, I'm not putting 3 million bucks in somebody I just met. And so then all the sharks go out and you have no show. So that
Hmm.
becomes a problem. So I actually lowered it from 3 million down to 1 million. And even then the producer's like, ooh, we've never done a deal that big. So yeah, okay, let's see what happens. So that's kind of how it happened. So we kind of went for it. And what's funny is we were in front of the sharks for 90 minutes, a lot of questions, a lot of good stuff. But 4 of the sharks went out, right? Because I think the number was a little bit big for them. And so I thought, man, they were right. The producers are right. We're done here. And then Kevin O'Leary said, no, I'll give you the $1 million. And then came the terms. And so it just made the show, it was kind of like oh my God, this is over, to, oh my God, this is actually going to happen. And it went from there. So it's cool. It was cool.
It's like hitting a blackjack on your last few hands at the casino.
Yeah,
I guess
exactly.
I'm saying, did you like the terms that were offered after that, or was the
So
million?
what happens is after that, the offer turns into a real offer, and now you have to create an LOI and a lot of terms that come with it. And that's where we couldn't agree on the terms, and that's what made the deal fall apart on the back end.
Just being already at 5 to 6 million run rate, expanding, growing? Did you even know, though, that you were going to have such success that boomed off that because of all the eyeballs? Was that a factor that you considered, or was that another blackjack that you hit and you said, "Oh wow,
We,
nice"?
it was another blackjack that we hit, and honestly, we weren't really prepared well enough for it, and that's what subsequently led us to exit earlier than I would have imagined. And so what happened was we beefed up our servers, anticipating things. And literally, as the show's going on, the server crashed like 4 times of people pinging our website and trying to inquire about what we did. And that's the power of the show, right? And so when we were done, I think we ended up with a couple of thousand inquiries about wanting to be a franchisee with us, of which like 20 or 30 folks actually signed up and bought multiple units. And so within a year, we had 200 units to go build out over like a 5-10 year time period. And talk about growing yourself to death. And so now we were in the hustle. We had to try to double up on staff, and things were moving, and we were having a hard time because the real estate market was very challenging at that point. And so we ended up not being able to get the stores open fast enough like we wanted to. And that's when I went to my brother and said, hey, it might be time for us to exit and let somebody that's a bigger operation be able to handle the growth. Because otherwise we're gonna miss the mark and we're gonna be in trouble anyway.
Hmm. And you already went through one exit of your book of business back when you were in your first career in finance. How different
Yeah.
was this? And did the acquirers, did they look at that tremendous franchisee growth and the opportunity to build out the units in your valuation and your deal, or did they
Yeah, it was
say,
very
well,
different. So I would equate selling my wealth management business as what I do today, which is profitable business with positive EBITDA, right? With a seller needing transition, right? To how do you roll not profitable, had a lot of top line revenue and had all the possibilities of growth with a new concept, new idea, franchisees lined up, right? Systems lined up, much more like a venture exit, right? Much more like a venture exit. And so what's interesting to me is that when I look at it, I think when I exited the wealth management business, that was an easy business for somebody else to take over and grow it some more. And the folks that bought it, my ex-partners and other folks that bought the practice, they really were able to grow it over the next 10 years, right? I think how do you roll given where it was and what was happening? I'm not sure that the private equity really was able to take it any further the way it was. And that's the risk of venture, I think, when you think about the overall, right? Now, what they wanted was the IP of how our sauces were done, our systems, everything. And it worked very well into the next iteration of that concept, which was the poke bowls, right? And you see those concepts all over the place now, where instead of trying to do a roll, you just slap everything in a bowl and it makes it easier, right? But the sauce is the same, the fish is the same, everything is the same, but a much more easier process. So those are things that evolve. And so I think of the exit of how do you roll is much more like a venture exit, and the wealth management practice much more like private equity acquisition.
I never realized the Poke Bowl is a
Derivative of the
adaptation.
sushi roll.
Yeah, it's an adaptation.
Yeah, so
for
now
the
you got to think about
survivability
that next
of
time
the
you're
sushi.
there.
Wow. That's something I didn't think I would learn today.
Yeah.
So then, so much more like a venture exit. And how did it feel after that? After you did get that exit, they took it over and you were looking at the world like, okay, what do I do now? Or you had an idea?
I took 4 or 5 months off. I didn't know what to do next. I did some consulting work for some friends that were in business. And just to do that, I wrote a book. I was like, okay, what am I going to do? Write a book, watch all episodes of Sopranos, all 6, 7 seasons in a month. Great series. Loved it. And just trying to figure out what I was going to do next. And so then that kind of led me to my next iteration was jumping into the private equity of real estate. And that led me to the next career path as I went.
So you went back to something a little stable and predictable after that.
Yeah, it was an asset category that was not what I was most familiar with, where I had the most knowledge in, which is the same reason I was attracted to that sector, right? Which was I wanted to learn more about the innards of how a real estate deal was structured, how things were happening, how the capital worked for it, and how real estate people were making money doing what they were doing. Because previous to that in wealth management, I did real estate, but it was always through a REIT entity or direct small deals, right? And so it was interesting to me to do the innards and be on what I call the GP or general partner side of how a real estate deal was done and how you had to put it together. And it was 8 years of that with Casoro. First as CEO of the capital side and then CEO of the whole conglomerate. And they were good years and it worked out well. And then it was just time to move on, right? Because I think that market has really taken a pretty big hit over the last 2 years.
Some fluctuations not a lot of people readily would have been able to predict.
Yes, that's a great way to put it. I don't think we would have ever thought that interest rates were going to jump from 2-3% to 7-8%. Literally overnight. That created a lot of problems. And then rents starting to come down and things just slowing down.
And the major whipsaw of supply and demand, where essentially there was, with COVID, there was no supply, and then the demand was super high, and so the prices go up, and then it's like
that's right.
Yeah, so just
that market that tail whipping back and forth really created a lot of problems, and they're still trying to figure it out right now. So all my real estate friends and folks I talked to, they were hoping interest rates would have been down by now, but that didn't happen. They were hoping rents would be up by now. That's not happening. So there's still some challenges in that real estate market.
Mm-hmm. There was a clip that I saw. It was an influencer. They sold their business, made a lot of money. And one of their friends said, "You should come into real estate and co-invest with me." The guy was buying real estate and things like that.
Yeah.
And it was actually a girl that was talking about this, and she was talking to her friend, and the friend said, "Yeah, it's just passive income. It's very easy. You should come and do it." And then she said she invited her in, and lo and behold, she has a team of 40 people, and she's like, "This is passive income? This is not passive income?"
Yes. Yeah. If you're just an investor, yes, passive income. If you're on the general partner side, no, not passive at all. It's as complicated as running a restaurant. Think about it. If you have one apartment complex, you've got 400 families, 300 families living there. A little more complicated than you would think. And the other thing is a lot of folks have not experienced this because the real estate market has done well. But if you're invested in real estate, even as a limited partner, a lot of them are getting capital calls, meaning they got to put more money in. And I don't think a lot of folks who invested in real estate thought that was going to happen or anticipated that was going to happen. And that was part of what they would have to do is put more money into it. So again, challenges of that sector. And I always tell people as a CFP and as a wealth manager, I always tell people you have to diversify. You can't do just real estate. You can't just do private equity. You can't just do stocks and bonds. You can't just do commodities. You have to have it all, right? You have to spread that risk out if you really truly want to invest passively and be able to get a steady return without a lot of operational need there.
Interesting. Which is the counter mindset of a lot of entrepreneurs that
And
get
that's
big quickly
so,
in the sense of they
yeah.
focus in on one thing and I need to get this to work. And then,
Okay. So that comes to the conversation of high risk, high return, low risk, low return, right? And so if you're trying to reduce risk, then you have to expect that returns come down with that. If you want high risk, which is concentrate all my efforts into one category or one thing and be the operator and take the risk of being the operator, then you should get the rewards for that. If things work out well, you should be making 20, 30% returns, not 8 to 10% returns from the stock market where you don't have to put any effort or energy in. And so it depends on where you are and what you're focused on. Now, I will tell you a lot of wealth, real wealth is not generated by passive investing. Real wealth is generated by active investing, meaning that you're involved and there's operational risk and you're the entrepreneur or you're the GP. And that's really where the big returns come in if things work out, right? If you're just investing and you've already got the wealth built up and you're preserving and just growing it to a certain level, then that's where diversification and passive investing works very well.
interesting. Spoken like a true financial planner there. Great financial advice for sure.
Yeah.
And then when the step into Halbar. So, and I'm also curious about why real estate. There's probably a bunch of other things you thought you could do. Why just that one in particular?
You know, what's interesting is during that 4 month of time off, you have a lot of time to think, right? And reflect about life. What's interesting is I could have gone back to wealth management. That was definitely one of the options I was considering. And I loved that business because I loved working with people. The other option was to go into franchising, franchise consulting, right? Which was what my brother did. He actually decided to become a franchise consultant. So he consulted with franchises to help them grow their franchise because he had the skill and the knowledge. I thought about that as well. I was not as excited about it because I felt like I wanted to build something again. And that's how I fell into real estate because there was an opportunity to partner up with somebody that was already doing it. Again, that entrepreneurship through acquisition feel. Then after that, partnerships fall apart and things happen and it's just time to move on. And the opportunity to work with my current business partner in this ETA space, entrepreneurship through acquisition, also known as search fund, you'll hear that term a lot as well. The opportunity just came up and the thing for it just fits who I am, right? I love the conversations around business. I love the conversations about the opportunities around business and entrepreneurship. And so it just felt like the right thing to do. You're right. There's always a lot of options. You just got to find what works well for you.
Mm-hmm. As you said that with Casoro, the real estate, and with your brother as well, it was finding somebody who's knowledgeable, has a foundation or a desire in that business, and you and as that person has the financial mindset and can really be that partner that they're looking for. So,
Yeah. So here's my soapbox about partnerships, right? I've had good partners and bad partners over the career, but I've always had partners all throughout my life. I've always had partners because one person typically can't go it alone in anything that worth building. And be very careful about who you pick as partners and make sure that you understand what that sounds like and looks like so that there's a way to engage in partnership and there's a way to exit partnerships. And so there's a lot to it and there are inherent rewards and dangers to partnerships. And so as long as you understand that and know how to get in and out of those, then having partners is a great thing.
talk about some of the risks with partners potentially, or more selecting the right ones. How do you go about really finding the right ones versus
I will tell you the
having
thing I learned. Yeah, the thing I learned over having different partners is that if your value systems are not aligned, it will be a bad partnership. I don't care how, the business is doing. I don't care, how much money you're making. If your value systems are not aligned, then it will fail. It will be a bad partnership. You will be unhappy no matter what. It's kind of like marriage in some cases. But if your value systems are aligned and you see the world and value people and have the same thought processes about how life should work and how business should work, then the partnerships work great. You just keep going and there's no friction there. And it's very smooth and very workable, even when times are tough or even when times are good. It's irrelevant. And that comes down to human beings and their values, right? If I value people over things, then my business partner has to have the same philosophy, right? If I value taking care of people and helping others, then my business partner needs to have that same value system. If I care about my family and my kids, they need to have that same values. And all of that is really what it really comes down to make sure you have the right partner. And that's what you have to explore more so than the business idea and whether or not the business is going to be successful.
Interesting. Never heard that before, but I know it's great guidance. What are some of your business values? You mentioned some that are people and family and whatnot values, which definitely correlate to your business values, but do you have particular and specific business values or just a broader set that might incorporate some other life elements which are fundamental to the way that you see finding that right partner and a good fit with your value system?
So I always build businesses based on my personal value system, just to put it out there. I'm not saying that's right or wrong. That's just how I do it. And there are a couple of key elements of my own life that are written down and I live by. And the fundamental guidelines for me are family first, believe in hard work, challenging work, believe in betterment, that you're put on this earth to try to make it better, not worse. Believe in honesty and integrity, meaning that if you say something, even if it was not documented in a legal structure, you still do what's right. Always do what's right. The Spike Lee, do the right thing. And leave the world better than you found it. It's that simple, right? And it should be a do no harm type scenario, but also improvement and progress and the belief that is part of why we're here, right? And fundamentally, as a human being, I shouldn't be just a consumer and consumption. I should be a value creator. And so those are the philosophies that I live by. And when I do business, my business partners hopefully have the same belief system, which that's part of the conversation to begin with, right? And so that was very important.
Powerful stuff. And if you're going to find a search fund CEO, someone who wants to acquire something, do these come out through conversation? Is this a process which you would instill before you go into business with one of these people? Would you sit down with them and have a dinner, or what would that look like to really make sure that you're finding
Yeah, Nova Stone Capital, or NCA, is our business partner on the recruiting, mentoring, and searching process. And they have a very long process. So it takes about 3 to 4 months before somebody can come into our systems to be one of our entrepreneurs, right? Our searchers. And so it's a very long process. And that goes deep into the value systems, their work ethic, the grit, their vision, the background, like the MBA background, all that, that's just table stakes, right? We assume you have to have that. If you don't even have that, then we're not going to have this conversation. But once you have that, then it's all the other intangibles that I just mentioned that really then drive whether or not somebody comes into the system.
And what about acquisitions? When you're actually going out to make that acquisition or find the company that you're going to acquire, how much of that Albar side and how much is the entrepreneur that's coming in wants to acquire them just being really?
Yeah, good question. Yeah, I see what you're asking. So the way the system works is actually, and IC, which is an investment committee, they have multiple investment committee meetings, meaning that all the way from the beginning of, hey, entrepreneur says, hey, I've got this deal. I like it. Here's what they do. Here's the basics. I'm still digging in. That is a conversation in a meeting. And then it's, okay, now, this is what I've found out. I've signed an NDA and I've got more information and I want to put in an LOI, letter of intent. And that's the next step. Okay. The investment committee is heavily involved in that process. So this process is unique in the sense that it's never oh, good luck, searcher. I'll see you in about 12 months. And if you find a deal, great, we'll jump in. And then we'll jump in. No, it's all along the process. So that by the time it gets to, okay, we're going to make an offer to the seller, we all already know that this is a deal that we all want to be a part of.
What about the finance elements, being that you have that deep finance background? Are you looking for businesses that are decently profitable, ones that could be a lot better, or metrics that you're shooting for? Acquisitions?
Well,
type.
Yeah, from a what I would call a mathematical number standpoint, we're looking for 1 to 10 million EBITDA with certain levers that can be pulled by the entrepreneur to then grow the business at least 20, 30% per year minimum over a 5-year period, right? Because we're shooting for a 30% targeted IRR, rate of return, internal rate of return to the investor. So we have to do deals that we know have the possibility or high likelihood of making 2, 3, 4x their money and returning a 30+% rate of return to the investors.
Gotcha. Makes sense.
Yeah.
And then getting it up to, for example, from your 1 million to your 3, or your 3 to your 5, hitting those break points, increasing the multiple. But it comes back
That's
down
right.
to that, what you're saying, that 20 to 30% growth rate year over year. And then,
Yeah. I mean, from a mathematical standpoint, it's pretty easy in the sense that, okay, if I buy something for, let's say, $1 million EBITDA, I buy it for 5x and it's a $5 million company, right? So I buy it for $5 million bucks. If that thing can grow the way we think it can grow, then in 5 years, let's say it's $2 million in EBITDA, right? Just hypothetically. And if I sell it for 5x, now I've made $10 million. So I've already made $5 million in profit. That's the simplest formula of what we're trying to do, except that we accelerate most of those elements.
what would you say your secret weapon is at Halbar? Is there anything in particular that your team and your
Ooh,
skill set brings to the table?
that's an interesting question. I don't know what the secret weapon. In a lot of ways, it's a lot of different things. One is I would say that my business partner Nate is a super ninja himself, right? Yale MBA, right? Total stud, and in a lot of ways, he's so sharp and so quick on the thought processes of deals. I think that's part of our secret moves and secret weapons. But then also, I think it's also when you think about the small team that we have and how everybody plays their part and tries to get things to happen. It's more about building the team, the Justice League, than it is about Superman. It's not one person, right? And I'm not saying Superman can't do a lot. Superman can do a lot. But man, it'd really be nice to have Wonder Woman, Batman, and Aquaman and everybody else involved, right? The Flash or whoever, whatever you need. And the reason why is because that's really what it takes to really grow this into a multi-billion-dollar business. It's going to take all of those efforts and going to take all those superheroes to make it happen. So
And that's the goal, multi-billion.
it is. We want to grow Halbar to a multi-billion-dollar investment platform.
And so one of the things I recently heard, and I think in times where I've really been dialed in and crushed it, I focused a lot on the inputs and the goals
Mhm.
just as a result. What is
Mm.
your team's mindset or your mindset, being that you've achieved goals, you've had exits, versus focusing on inputs and really mastering those inputs versus the outputs and engineering for that goal?
That's interesting. I'll just share how I think about it and how we do it. We do a one-page strategic plan. On that one page is our value systems, what we're trying to hit on a quarterly basis, what the overall goal is, what our big, hairy, audacious goal, big BHAG is. All of that is all listed, and then the steps that we need to take to make that happen. And I use that as the guideline of what I do every day, right? Okay, oh yeah, we need to get going on this, and we still haven't done this, and we need to raise this much money, and we have these many deals in the pipeline, and we need to bring on these many entrepreneurs into the fold. All of that becomes very clear on one page for us. So then it's just a conversation of, are we hitting it or are we not hitting it? I know that like sometimes a lot of people, and then this maybe comes from more of an entrepreneurial background, but like maybe if you're a big corporation and stuff, you have all these like pages of goals and words and all. I'm like, no, I know exactly what I need to do. I don't need all of that. And so I think of it as this is more of a nimble entrepreneurial venture.
Thinking more about clarity versus content.
Yeah, yeah. It's going back to philosophically, if we know why we exist as a company, then what we do and how we do it is pretty easy and adjustable at that point. But we have to know the why part first.
Mhm. So then that one-page strategic plan forms the why. And then as you're growing, so you said you have a small team. I'm just curious to get your insights on how you've seen that scale in terms of
Mhm.
how you started to manage bigger teams, bigger people, bigger
Yeah.
numbers of people, maybe even some of those different organizations, how you're working with your entrepreneurs in that case to manage. Because a lot of people would think that in your position, once you start to acquire a bunch of companies, things would get very complex and all that.
Yeah. So there's a couple, it's in layers, right? It's in layers. So when you think about it from a company perspective, the acquisition there, however many employees they have, whether it's 50 to 100 to 200, that's all run and managed by the CEO, the searcher who becomes the CEO of that company. We then typically will try to take a board seat and sit and try to work with the CEO from a board perspective, right? On the operations of Halbar as an investment firm, that's where the infrastructure grows as the assets under management grows, the amount of acquisition grows, the capital that comes in grows. That's where then the infrastructure grows. Right now, I need people who are managing the funds. I need analysts. I need people who are out dealing with investor relations. All of those start expanding now as where we are today versus where we're going to be. Right now, we're at about four folks, right? Four employees, technically contractors right now. So four folks, but as the next fund rolls out and as we raise capital, then we have to add one or two more bodies. Then we have to add another one or two more bodies. And very quickly, it expands to where now all of a sudden we're 10, 15 deep, right? In terms of where we are. Then you go the next round and you do a bigger fund, and now you have institutional capital coming in and you're doing $500 million to $1 billion. Guess what? Now I need to hire double up again. So I go from 10 to 25, right? Overnight. So that's kind of where that goes. The hardest part about that transition as you go through that is being able to lead all of those people, right? And when you go from 4 to 8, you're like, okay, hey, handle it, but what I need to do. And then when you go from 8 to 16 or 20, that's a different thing. And then when you go to 50 or 100, that's a whole nother thing, right? And so you have to be prepared for that kind of growth and know philosophically what you're supposed to do to handle the team growing the way it needs to grow.
And how do you look at the practical side of leadership in that case and how it expands, the day-to-day?
Yeah. So
part of it is what you mentioned there. It's almost like through the board, for example, you're controlling what you can control. In that board seat, you have a certain number of actions or kind of influences that you can take within that.
That's right.
And talk about just from the leadership perspective and how that looks with a broadening and expanding organization and some of the things like you said with leading.
Yeah. To me, the key is exactly what you said. It's leadership, not management. We tend to think that those two words are the same, but they're not. And as you grow, especially when you're in hyper growth mode, you need leaders, not managers. People who can help inspire and cast visions and get people to where they need to go that they otherwise could not. What you want to manage is the systems and the processes and the SOPs and all that fun stuff. That's a management task, right? That's very different than a leadership task, which is about humans and people and how to move them forward and make them productive to hit the goal. First off, philosophically, you have to understand that and know that's the end game. From there, what happens is that as you start growing, I've always said that one person should not have any more than about 5 to 10 direct reports to them. Once it gets past 5 and you get to 10, you start losing control. Because you can't lead that many people because you're trying to lead folks and then to have people who manage certain operations and execution. And so it's very important to know that you're trying to grow leadership and what does that mean and how does that work and how do you define that growth for people? And leadership is about growing people, growing them individually and growing them as a team. And it's as you go. And as the body count starts increasing, the leadership needs to increase with it. Yeah.
And as you're looking forward now, what are some of the things that you're trying to learn as you're going throughout this process? Some of the new...
I'm trying to learn the capital markets better than I felt like I knew and understood. And every time I feel like understanding capital is an evolving thing. And there's flavors of the month of what people should put money into and how people allocate and their asset allocation and their betas and their alphas and all that fun stuff. That net, as much as I feel like I know, I feel like that's always a movement and things that are changing there. And so I try to have to work very hard on staying on top of that, right? And understanding the necessity of what we do and how we do it. That's one thing. The other thing is really when you think about the type of business we're in, we are more in the influence business than control business. Unlike the last couple of companies that I did, that was much more control, meaning that my hands and fingers were like in it. I could roll a sushi roll if you needed me to, or if I had to clean the toilets, I'd do it, right? It didn't matter. It was like very deep. Being an investment firm, allocating and investing, buying companies for CEOs, it's one step removed. It's more almost feels like I have gloves on as opposed to hands on. Because the CEO is the hands-on. So it's a different position. I'm used to being the CEO myself, right? So the positions are a little different right now for me. And so I'm having to learn that. and learn that it's okay to kind of let go a little bit and let the CEO do what the CEO needs to do. Because I wouldn't want somebody all up in my business when I'm the CEO trying to grow, right? And so having to learn that is another big learning. So a lot of stuff. It never ends.
And how do you learn mostly from books or by doing, or how would you learn that particular skill set? Because it seems like a unique one.
So I'm reading The Laws of Human Nature.
I have.
And it's what's beautiful about today is information is just so much more readily available and at your fingertips than it ever was. And obviously, yes, reading books is part of it. Going to seminars could be another part of it. Listening to podcasts, kind of like this, right? Learning from other people is a big part of learning nowadays. It's interesting. I feel like nowadays when I need information or I'm trying to understand something, I can pull it literally off my phone somehow, some way, whether I find the right podcast or whether I find the right book or whatever it might be, and maybe there's a seminar going on or there's a conference going on about a certain topic. It's all readily available now, and that's really cool. I felt like when I was much younger in my early days, the only option was to go find a book and read it, and then hopefully you find a coach that could then help you through that process. Today, if I go to YouTube, I could find stuff, right? Like it's just amazing. So it's just so different, but it's all there. And I'm very big on telling people that, hey, look, for myself and for everybody around us, we need to constantly be learning. You don't ever want to stop learning. And whether it's something related to your business or something for your personal growth, it doesn't matter. Always keep growing your mind, right?
So throughout the levels and the successes of your life, the exits and what you're doing now, what changes have you made throughout your life, throughout any part of this journey, that have given you what seemed to be a 10x improvement at that time? It could be you tried a different system, different approach, you learned something specific, you bought something, you experienced something. What might a set of those be?
That keeps morphing depending on the business and what's going on. I remember early on in the wealth management business, I was one of the earlier creators of lunch and learns, where you would get a group of professionals and do a topic, and then some of them will become your clients. And that was revolutionary back then because everyone was cold calling back in the day. And then in the food business and the restaurant business, it was learning the franchise business and how franchises can help exponentially grow you 10, 50 times faster than just trying to do one store at a time yourself. In the real estate business, it was trying to figure out how to get more institutional capital so you can buy more assets and run the systems harder and faster. In Albar today, I would say the 10Xer is how to work with institutional partners on a different asset class, right? And figuring out how to make that happen and working with family offices and high net worth folks. And what is the best way to figure out how to share a story on a sector that has been there forever. It's the highest performing sector in private equity, yet no institutions really know about it. So I'm trying to figure it out. I'm trying to figure out how to 10X this bad boy, right?
Right. Say private equity, one of the best kept secrets, especially
Yeah,
a lot of investors weren't able to get into it for quite a while. I think even
that's right.
disruption wise.
Yeah, and I think the space is hard to scale, and I think we finally figured out how to scale it, and I think that's our 10X strategy right now. So today, I could do 30, 40 deals, right? Whereas before, you could barely get through one or two. So that's part of the process. And so, yeah, I don't want to share the secret sauce too much, but that's what we're working on, right? So we feel like in the next 5 years, we're going to be the leader in this space.
Well, as long as I got you all the way up to, we don't want to share the secret sauce, I probably got a lot of information for people here up into the secret sauce.
That's right.
So, Yen, it's been great to have you on the show.
Yeah, thank you.
my,
Likewise.
my last favorite question to ask here is always, what is one question that the listener should be asking themselves as they have taken information in and want to go back into their lives and put it into something meaningful?
That's deep. That's deep. I think for me, it would be, how do you create a life of meaning by not only just being successful, because success is actually not the end goal, but how to be significant. And I think that's the question that I hope your listeners ask, which is whether I'm successful or not successful at this moment, how do I become significant as a person? And so I'll leave it at that. I'll leave it at that.
So we're going to break character here in some sense. What's your answer to that?
So say again?
What's your answer to that?
It's about, for me, it's about the impact and the effect that I've had on the people around me. And what I mean by that is, was I a good husband? Was I a good father? Did I do my duties as a son for my parents? Am I a good sibling, right, to my brothers and sisters? And am I a good family member to my cousins? And what about the people that are around me in terms of work and the nonprofit work that I do? Am I making an impact? Am I changing the lives of the people I mentor? All of that becomes that significance that I'm seeking, so that when I'm done, did I make that path just a little bit better for the rest of the world? And that's really the most important thing. Yeah.
Definitely. Yeah, I've been thinking about that a lot more. And I think that one of the mindsets that brings up to me in a way that I'll be applying that is as I'm going out to do my marketing or my selling or anything like that, and when it comes to growing the business, rather than just focusing on how do we maximize the open rate, the conversion rate, the yes rate, the sale rate,
Yeah.
how do we form messaging that will come from that place like you're talking about? And can that convert better? Can we build better relationships? Can we build a better business by simply answering that question first? How can we build something or be that kind of meaning, the person of meaning and significance, thinking from what people need and really value versus just
Yeah.
conversion rates and click rates.
I love it. I love it. Titans of today, right? And why is that even important? And why do people want to listen? And what do they get out of it? And how do they become Titans? Or maybe they already are Titans and they just have something to share. What do you think to improve on the world and make the world a better place?
Right on. Yen, thanks for being on the show.
Yeah, likewise. Thank you, Jacob. Appreciate your time. Thanks for having me.
You bet. We'll have to follow up sometime in the future as you're on the way to that one bill.
Thanks.
Yeah. Hey everyone, thank you for watching this episode of Titans Up today. What did you learn from it? Make sure to drop a comment below with your most valuable insight so that other people can engage in the conversation around what this speaker brought to the table. And then on another front, make sure to subscribe so that every time we drop a new episode, you will be notified. And that way you can keep fueling your dreams and your brain with fresh insights which can help you along your journey and along your path to your goals. So thank you so much again, and I look forward to seeing you in the next interview.